Well, good day, and welcome to another FS Club seminar, webinar even these days of COVID-19. And in fact, that is the title of today's webinar, really from COVID-19 to COP26, the changing role of financial actors. And I'm extremely thrilled. This is what I've been looking forward to some time because we have with us Nick Mabey. Nick set up E3G, a very famous and renowned environmental think tank, over 20 years ago with Tom, and the two of them have done some absolutely fantastic work and made a number of initiatives happen, in particular things like the Green Investment Bank. But I'll let Nick chat about all that when we get going. So welcome, Nick.
Thank you very much.
I need to start, of course, and I will end with a thanks to our sponsors. So without the sponsors, this wouldn't be possible. I'm conscious that many of the sponsors are involved in issues to do with green and green finance, as well as the various technologies surrounding the environmental movement and our move towards a more sustainable planet. So I'm pleased that they have volunteered to help us run this series, in which Nick is an important part. The agenda today is, as ever, fairly straightforward. I'll get out of your way quite quickly, and we'll hand over to Nick. There's about 25 minutes worth of presentation that Nick has, 20 to 25. We will have a fairly strong Q&A session towards the end, and I would encourage you to use the question bar on your facility where you're able to just type in questions. I'll be fielding the questions to Nick, and from time to time, maybe amalgamating two or three where there's a bit of redundancy and trying to lead a discussion forward. I hope that all of you want to participate, so please do go ahead and fire questions away. Anyway, with no more ado, if I might, Nick, you've got so many fantastic views. COP is, of course, an amazing thing for Britain to host, and then suddenly we got dumped with COVID in it. So I'd be very interested in your thoughts.
Great, thank you very much. And it's a real honor to be part of this series and to give some of our early thinking about how COVID changes the context of COP26 and climate action overall. But firstly, just to give a brief introduction to E3G and myself. So I say we're an environmental think tank. We work across Europe, but also globally across a wide range of issues related to climate change, including finance, but also security and diplomacy. As Michael said, we try and do big things like the Green Investment Bank, but also doing a lot of work on multilateral development bank reforms at the moment. And we also advise a whole range of the UK and European governments on particularly climate diplomacy and strategy, because it's always important to know where the money comes from. We're mainly funded by philanthropy and governments on a grant basis, and my background is mixed, but I spent time in government and also academia and industry. Next slide. I'll give you kind of a brief overview of what I'm going to say, and then I'll say it again because it's always useful. But really, we were going into COP26 needing to do more to keep us safe. Paris was a good start, but didn't get us to where we need to be. But COVID has really upended that strategic landscape and requires a complete rethink, not of what climate ambition is, but about how we achieve it. And of course, the dynamics of COVID are hugely uncertain, and so are the geopolitics delivered by COVID. But the real shift for climate actors is, whereas we were going to use COP26 to drive the geopolitics of climate change in a relatively flat environment, now we've got to ride the wave of geopolitics and geoeconomics caused by COVID. And that really means that instead of COP being the center point of climate ambition, even though it's still important, it's really the decisions over the next 3 to 6 months on recovery packages, and perhaps even more important, the next 6 to 18 months on debt restructuring and how we cooperate globally, that will determine whether we can actually stay within safe climate limits. So we need to make COP work. It's part of that process, but it's not as strong a centerpiece as it used to be. But in fact, delivering better recovery packages, particularly starting in the UK and the EU, other major countries like China, is going to be the biggest diplomatic asset we now have to shape COP26. It's very different 2021 more broadly than we thought before. And the real question I'm going to take through this, and looking forward to your response from, is this really means a massive pivot towards public financial decisions and reforms. And the question is, what's the role of the private finance sector now in shaping these reforms, these actions, and these processes, and supporting the climate stability everybody, not least investors, needs. Next slide, please. So the cool thing, you may have seen this slide before, this is just showing what we need to do to stay inside the safe region of well below 2 to 1 degrees and what we got out of Paris. Paris made us a lot safer. It reduced the probability of 4 degrees by 80%. But there's still a big gap, which we needed to get that extra mitigation in COP26 by 2030 if we were going to be on track to the safe range. Next slide, please. And going into, before COVID-19, when I was presenting detailed strategies for COP to governments around the world, this was the landscape we saw. Quite a flat geopolitics, kind of pushing against climate action, kind of a lot of tension between major countries, quite a lot of distrust because of the Madrid COP. The UN Secretary General was in a bit of an ambiguous position because of what was seen as a relatively weak climate action summit, and a narrative that the climate process was failing. But we also had some tailwinds pushing us forward. Obviously, cheaper clean tech is really important. We had loads more businesses, investors, and cities putting commitments forward saying they were going to go net zero. We had the wave of school strikes and Extinction Rebellion, particularly in Western European countries and America, putting climate action on the table. And actually, globally, climate action was rising up public attention. And we also were getting engagement from central bankers and others in the financial sector. So, a balance of forces both ways. But one of the big issues we had was trying to actually get attention for anything on the global agenda when things like the US-China trade war were dominating headlines. Next slide, please. And so what did we expect to get out of COP this year when it was still planned? Well, we did a lot of work on this and looked at it and said, for even in our best case scenario, which was really driven by strong European and China cooperation, that we would fall well short of a kind of clear trajectory to well below 2 degrees to keep in that the safe zone that scientists have identified. And so the UK was looking to complement these kind of formal pledges countries put on the table at climate talks with broader campaigns to change the real economy and support and persuade people to do more. And those were very focused on phasing out coal, something we work with them. But there was a big set on private sector finance regulation led by Mark Carney, looking for mandatory climate risk disclosure, central bank stress test commitments, and private investors to increase their commitments to low carbon financing, aligning portfolios with them. There was a whole stream of work where Nick Stern was very involved on public bank alignment and potentially increasing the capital to public banks. That was seen as a very heavy, ambitious lift to give public banks more capital. Shows how much things have changed. But there are also campaigns on phasing out internal combustion engines by 2035 and improving nature-based solutions and changing commodity markets, as well as a big focus on building resilience globally. But even with all that work, even if all of that diplomatic work and commitments, we still thought it was pretty hard to get an outcome in Glasgow that was really going to make sense. And if you want to look at, this is some of the benchmarks we developed, and these have been tested with governments on, what do we mean by high ambition? It means, countries would pledge to bridging the 15 gigaton gap by around 5 gigatons, but we might get half of the global economy inside, half of the global emissions inside net zero targets by 2050. We could get huge shift on coal finance, a doubling of climate finance through the development banks, and around over half of car sales committed to phase out by 2030 or 2035. So that would be, so if we managed to get all of those commitments in our high ambition scenario, we would have been quite on the way to showing some real progress. Next slide. But everything's changed, and obviously we're now in a very different place where COVID is dominating national discourses, and we're looking at a whole range of impacts. So obviously the first round impacts in now is about COVID impact themselves, large impacts from lockdown, growing debt, implications for fiscal space, for government spending and investment. But we've also got to look at the potential for second round impacts, looking at financial crises, both at the sovereign level and at the company level, particularly in oil dependent countries because of the low oil price and the impacts on balance sheets, which we're seeing financial risk measures going off around the world, particularly in India. And third, around impacts, we're seeing a lot of warnings about global food crises, and that's also compounded by climate impacts, locust infestations in Africa. So we could see a whole set of cascading impacts. Next slide, please. And we kind of look at these and the different bits of uncertainty. We keep on being asked, give us some scenarios for how the world we're going to live in. And we say, really, the uncertainty is too strong. Not only do we have this very these set of exogenous shocks, which contain all those three phases. The next level of uncertainty is how are we going to respond to them? Or how quickly will we, what kind of recovery packages, how much international cooperation, how much leadership, what's the tension between national and shared interest in the crisis response? And then already seeing this, there'll be a political response to this whole area. Once normality starts to come back, we'll see issues of cooperation versus isolation. What's the role of the state versus public expectations? How does public support for climate action survive? What's the politics of globalization? And we're still in the middle of this. It's too early to give a call out areas like geopolitics, but you can see from this kind of set of cuttings, you've got everything from the weaponizing of Chinese relationships in the American elections, the kind of bioweapon conspiracies you're seeing in Chinese and Iranian and other pushes. We have seen the G20 and the UN look at cooperation, but also seeing a kind of mix. Is a China meeting on coronavirus control a mark of cooperation or Chinese geopolitical power? So I think we're seeing the really difficult to know whether we're going to see more cooperation or less cooperation next year. But for climate change, we really need to make sure it leans towards cooperation, and that's one of the key themes of moving forward. Next slide. So in this context, massive uncertainty, the one thing we do know is not going to achieve climate outcomes through climate venues anymore. And also changes we expected to see over 5 to 10 years, like really integrating climate into economic decision making, will be determined by actions in the next short term. And there is a huge opportunity to change how particularly economic questions are being asked. So how do we look at fiscal issues? How do we look at debt in the long term? What's the issue of debt relief? How do we align that with climate change? How do we address sovereign risks? How do we improve resilience? It's clear we're not investing enough in resilience across the public and the private sector, and that's something about health, it's about food security, about climate resilience, social protection. So climate change has to get its space in this new arena, and the real question for climate actors is how to influence unfamiliar venues and build broader coalitions into these big questions. And the thing that's worrying my sector is, will climate risk miss this wave of change, and how does it adapt to this new context? And very much the way we're framing it and advising people through the economic part of this system, thinking about how climate can drive impacts through the three stages: the response stage, which we're in the moment, to the emergency, stabilizing the economy, then move into economic recovery, and then the longer term restructuring of governance and social investment. And it's obviously easier to drive those outcomes in the third phase, but there's things in the first phase we still need to respond to. Next slide, please. And countries are going through this at different rates. So at the moment, most countries are still in the stabilization phase. Perhaps only China is really doing economic recovery, though the plans are going on in the EU and Japan and the UK. By the third quarter of this year, we expect to see quite a lot of the major G economies into economic recovery, though Brazil, Africa, and India probably still in stabilization. But at the time we get to the middle of next year, which is the earliest we expect COP26 to be programmed, actually most of the major recovery funding will have been spent as under a best case scenario of kind of one round of COVID and not any huge cascading effects. So obviously worst case scenarios you could look at, but it's quite likely or possible we'll actually be focusing at the G7 and G20 next year in COP about these kind of forward governance, investment issues of politics of debt, and long-term issues. So if we wait till COP26 to win the green recovery argument, it will be too late. So that's why you'll be seeing in the press so many articles about green recovery, because we're learning a lot of lessons from the 2008 financial crisis, where the G20 talked a lot about green recovery, but only 12% of recovery funding was spent on green. But 2020 isn't 2008, it's different economics, but there are some lessons. One, you've got to make your mark when things happen. Political normality returns very quickly. There will be opponents of climate action pushing really hard, already seeing some of that. And the politics of crisis quickly becomes a politics of recovery and retribution and blame. But critical in terms of how this works for us is process design counts as much as it is. It's easy to have big ideas, but getting that actually into the development banks or the IMF or treasuries with the right calculus is much harder. And one of the big lessons from last time is a lot of people recognize green investment was a good deal, but actually getting the delivery, getting the money out there in the pipelines was much harder. And there's a real issue of how we build in rapid delivery into this recovery so we can get the right investment in the right places to produce both green outcomes, but also social outcomes. Next slide, please. So, but the other good thing is this is a very different time than 2009, and many things have changed. Countries have got much clearer climate plans, often out to 2050. We have much cheaper renewable energy. Financial actors are much more aware, much more public suppose, and I think climate is becoming much more economically mainstreamed into country plans from the European Green Deal to the South Korean Green Deal. So we're starting from a stronger basis to make sure that this short-term spending and medium-term reforms are actually aligned with climate. Next slide, please. And what we're looking for as part of the recovery are investments in all these areas here, from energy systems to resilience. Huge amount of money needed in resilience, huge amount of money needed particularly on the efficiency and heat. Less on renewables, a lot of renewable investments have been done. Huge on e-mobility is big. Public transport, electric buses will be very large, also changing more water mobility. Green hydrogen is seen as a huge investment opportunity, and obviously sustainable agriculture. So it's a very broad range of investment, much more than kind of offshore wind efficiency focus of the last crisis. We've got a whole economy investment opportunity now, necessity. And this sits beside a lot of other areas, also synergies obviously with areas like air pollution and health, nutrition, resilience. So it's a much bigger green stimulus, next slide please, than we saw last time, as well as a much cheaper one. And we're seeing that in the kind of immediate response, even though some short-term money has gone out of the door without conditionalities, we are still starting to see conditionalities on airlines and other companies, and some pushback against green financial regulation. But we're also seeing some big focus on green recovery in Europe, South Korea, some in Japan and China. A lot of the development banks have said they will only support green projects, and a lot of cities. And I think one of the key things is, especially with a low oil and gas price, that green investments look like a good deal. And obviously ESG investments and green investments look like they've had a good crisis in terms of holding up value. Next slide, please. And I think the kind of leading marker here is the EU. So the EU has at least a 260 billion euro investment gap in terms of its current climate goals. Those goals will be increased, so it's probably even bigger. Pre-COVID, there'd already been a €1 trillion sustainable investment package supported by the Commission to be leveraged through the EIB, with an extra 100 billion on just transition. The European Council of Heads of Government have said they want to see in the recovery package the green transition and digital transformation at the centre, and that's going to be part of a package put forward by the Commission later on. And it's likely to see kind of doubling of the kind of trillion from the EIB, and all of them will be not just focused, there'll be a large proportion focused on positive green investment, but all of it will be subject to the finance taxonomy that determines sustainability from a climate point of view, which excludes most of fossil fuel related investments. But one of the key issues on the green plan, as this shows everywhere, is that after the last financial crisis, 500 billion was spent leveraged through the Europe, which mainly went to Western Europe for green investment. And this investment has to go to Eastern and Southern Europe and disadvantaged regions if there's going to be a kind of social contract coming out of the crisis, saying very much not so much a green recovery as a sustainable, fair and resilient recovery, which everybody sees because they're all going to have to pay back the debt. They're all going to have to see the advantages. And so we think that really means we're going to have to see a much stronger public bank intervention to make sure, and particularly into investing markets and pipeline creation, to get the right money to the right places. Next slide. So kind of finishing off on that. So what does that mean for climate diplomacy? What we were planning to be doing at this time of the year in the previous space was be going around with these campaigns. UK with government would be working with lots of partners to kind of phase out coal, do some private bank reforms, work a bit on development banks, do some internal combustion engine phase out. Most of those campaigns are now being shifted to the beginning of 2021. There'll be still some work this year. But there's a whole set of new priorities to incorporate climate into the COVID response. And the first one is really on Build Back Better diplomacy. How do we make sure that countries are working together on their national reform packages? And particularly, as an opportunity for UK and Europe to build a joint approach with China, Japan, and South Korea to really set a large part of the global economy onto the right track. And that also includes, those last three countries, stopping international coal financing, which was already a target for COP26, but it would be ironic if we built more coal power stations in response to a crisis that's been exemplified by dirty air. And that's looking quite positive at the moment. There's lots of informal contacts going on. We also need to shape the immediate money being spent now. The World Bank's about to spend 160 billion in the next 3 months on immediate budget support. It's got to be clear that shouldn't lock in high carbon zombie investments, but also it's critical that it keeps clean businesses and supply chains open. There's a real crisis in Africa for pay-as-you-go solar at the moment because lots of households can't afford to pay their bills. So how do we keep the project pipeline and the businesses open that need to make the new economy, who are often smaller, less well capitalized, consumer-focused businesses, which means they're quite vulnerable compared to large state-supported high-carbon investments like Eskom in South Africa, who are being propped up by huge amounts of debt. And that brings me to number 3, and probably the most important new part of the climate agenda, is how do we make sure that the huge debt that's being built up globally to keep the economy moving during this first phase, that debt management gives enough fiscal space to increase investment in climate action, as well as healthcare and broader resilience. Now, we could scale up things like debt for nature or debt for climate swaps, particularly in countries like South Africa or Indonesia, who've got lots of poorly performing coal power stations. But that's not obvious. And I think this is one of the hardest, both kind of thought leadership areas, but also influencing areas, to make sure we don't, through a misguided austerity approach, close down the ability to shift out of dirty technology into clean technology. And core to that will be to capitalize and reform international and national public banks. Now, we thought that increasing the capital for public banks was going to be our hardest lift for 2020. I was just told by a public bank they were doing a year's worth of business in a week in Europe. Money is flowing to the banks already. They will be given more money. The question is, how do they spend it? And what's their role for leveraging private capital? And there'll be more savings, more private and individual savings. How do we get that money into climate transitions? Well, we think using the 400 global public banks, national and international, is critical to that. And there's a big summit the French will hold in November this year. It's an opportunity to really set that agenda. And finally, to kind of play back into the COVID crisis, there's a real need to use 2021, not just on climate, but as a real space to generate cooperation, to change that geopolitics and move it towards cooperation around building global resilience across health, development, energy, climate, food security, peace building. It's a lot of very practical actions. And the fact is, with the UK holding the G7 and Italy holding the G20, and they're both the co-hosts of COP26, there's a real opportunity to shape the global agenda towards cooperation next year, held particularly between the UK and Italy. Final slide, please. So that's like a landscape which climate actors are living in. That's the challenge we face to have our agenda integrated into the COVID response, as well as building into 2021 to have a successful COP26 as part of a broader set of cooperative moments, so we don't end up with fragmentation and the US and China spiraling off into a kind of Cold War. But I think that really puts some issues on the agenda for private financial actors. So climate action is now really dependent on major public financial decisions and reforms. And to be honest, the issues we used to struggle with on the dangers of crowding out the private sector have disappeared from the debate completely. But I think there's 3 big questions here. So in this context, and very different to the last crisis where financial actors were seen as cause of the crisis, not the solution, what is the role of financial actors shaping these choices? We've seen lobbying against financial regulation, green and otherwise, by some in the industry. We've also seen industry voices pushing for faster climate financial regulation. How should the financial sector work to shape the recovery? What is the role of financial intermediaries in financing the green recovery? If public banks are funneling private savings through green bonds and other instruments and do the heavy lifting, what's the offer from the private financial sector to make this work, to make it faster? We do have a problem with delivery in the public sector and the private sector. How do the private sector play into this? And what are the long-term changes to the public and private sector finance of green resilience? We'll see a lot of changes to the social contract, balance of state and private action in the economy. How does that impact finance? How should private finance play a role in this new world where perhaps the public wants to see what it sees as essential services provided by more non-profit or state-driven actors, so not so exposed to resilience. So anyway, those are a few questions on we thought it would be interesting to discuss, and I'll hand back to Michael to run the Q&A.
Nick, that was one heck of a tour de force. You really covered a lot of ground, and that's fantastic, and a fantastic set of slides, and yet you stuck to time and did a great job. I put a note out about midway through here asking people to pip in some questions, and suddenly I've been overwhelmed. I've been trying to sort of structure them. I see sort of three broad areas we might want to have a look at. One is the regional global tension. The second is the role of trade. And the third is probably about cost-benefit analysis, and we can probably touch on those. But why don't we kick off with a couple of direct questions from the audience. Bob McDowell kicked in early on with an interesting point here. Will institutional investors have to rein back their climate change demands, at least in the short term, to enable optimal corporate recovery?
I think this is one of the big questions. If we get the recovery structure right, then I don't think they will, because we should be bringing forward a pipeline of green opportunities, and that includes keeping some of the policy processes in track. So in Europe, they're looking to have a kind of renovation wave as one of the areas. So there should be hopefully a lot of green bonds available based around investment in public buildings, social housing across Europe, and that would give institutional investors exactly the kind of asset class they're looking for. The question of is the current stabilization money going to keep some zombie fossil firms going that otherwise wouldn't be, and therefore tilt portfolios? I think something the ECB is already thinking about. It's very hard. We were discussing with the trade unions, and they were saying, well, you can't not give money to fossil fuel workers on furlough because they can't just be given green jobs overnight. But I think that issue of does the money go to workers? Does it go to companies? What's the conditionality on shareholders? How does that relate to forward trajectories? Is one of the kind of very hot topics at the moment we're discussing with governments. So I think the answer is hopefully we will provide enough opportunity for those commitments to be accelerated, but it's still all to play for.
Nick, we got a question here from Kate Evans, and she's curious. Two things, really. What is, looking at COP26 and understanding that there's a bit of haziness about exactly when and all, but what's sort of the minimum that you would expect to get out of it, and what's the kind of the maximum, the shoot for the moon?
Yeah, so we're actually looking back there, and the minimum is we'd expect to see increased climate ambition in Europe, in UK, hopefully in China, and potentially in India. But I'd say that was kind of UK, India, UK, Europe, China is my bottom line, with a bit of South Korea, which might get us 3 gigatons of climate, and we might see some coal phased out, but really not a big shift elsewhere. The high end would see, backed by COVID responses, a real shift, over 5 gigatons of carbon committed reductions by 2030, but also probably a complete halt to coal investment in all countries globally, and the beginning of a halt to oil and gas investment commitments from public banks and governments. And there's a bit of discussion about whether countries will be more or less interested in phasing out internal combustion engines. in this area. I think it very much depends where they think they are on the supply chain of IC. So interested in people's views on the call. Was talking to the team in the UK government about this, where the politics of air pollution mitigate towards kind of cities and countries who don't produce oil in accelerating getting out of internal combustion engines. But obviously, countries dependent on oil, including the US, depending on will still under any leadership will still be looking to maximize revenues. So again, I think that one's up in the air. But as again, I think we haven't got a view on whether if we manage COVID right, we should be able to get more ambition out of COP26, to be honest. But again, it's so hard to tell at the moment because the overall politics is so massively volatile.
Okay. Well, there's a lot of rhetoric that COVID-19 is a global crisis, and that's sort of self-evident. But in reality, most of the, if not all of the initiatives appear to have been throw your borders up, flood your national economy with loads of credit to keep things chugging along as much as they can, and develop a local program. And even within the largest and strongest of the supranationals, the EU, it's really been a nation by nation response almost entirely. And so this leads into, I think, that first theme. People are kind of curious about, does this mean things like COP are going to be much more national or regional? I mean, should we give up on these and maybe look at these global initiatives? So Bob McDowell again was, will regional rather than global initiatives achieve more uh, in the next 5 years than global ones?
Yeah, I think this is the heart of the debate going on at the moment. We have a lot of, I think partly, there hasn't been a Gordon Brown moment in this. Partly there was no,
Sorry, could you just
there was no
explain that?
financial, there was no financial contagion. Last time we
Thank you.
had a 20 and elsewhere because there was a real focus on stopping financial contagion, having coordinated efforts. It's not the same here. You can stop COVID, and there was coordination on closing borders and managing trade and all those things. There's always more coordination than people see, but it has been a low coordination crisis compared to the last crisis, and the geopolitics are worse, particularly between US and China, compared to the last crisis. And I think, but we're also seeing the counter push, perhaps from those people who aren't the US and China, going, we now see our interdependencies. We're seeing the impact of lack of remittances and tourism and trade, and we see moves about shortening supply chains. So a lot of countries are realizing they need to push for cooperation because an isolationist response is going to damage them more. So that for me is the big fight in 2021. And that's why we think, especially the Europeans who have probably the biggest stake in keeping a kind of rules-based cooperative system going. But then so does China, building an agenda for cooperation where people think they can carry on being open enough to trade and people and goods and services while staying safe and stopping that kind of knee-jerk national populist ethno-nationalism we're seeing in some places. That's the big battleground. There's nothing predetermined, and I think that broader context will then determine whether things like COP26 and the Convention for Biodiversity the Chinese will hold, the big UN summits next year, are actually going to work. It will be very different if Bolsonaro gets kicked out, Biden gets elected, Modi is damaged, and Xi's under threat, than if Trump's re-elected, Xi's emboldened, Bolsonaro stays in power, and Modi seems to do a good fist, and Putin survives. So, anybody tells you they can say which one of those is going to happen, has got a crystal ball that I haven't. But that's part of the kind of wait and see. But also, we've got to act towards cooperation if we want to see it happening. There's no natural reason why it'll happen.
Well, actually, Raj Tamotaram gives me a nice bridge from the local regional over to trade in a minute. And he points out, you mentioned geopolitics. Clearly, the Trump administration's been keen to blame China, and no doubt China made some mistakes, perhaps big ones, but so did a few other countries. Chris Patton was writing in the Daily Mail saying this rhetoric is spreading. So if the China-US split deepens, what do you think this means for climate crisis and COP26?
I think the China-US relationship will worsen under any possible US domestic situation because Trump is pushing Biden to be tougher on Beijing. If you look at the polling in the US, even before COVID, it's the most bipartisan thing is suspicion of China. much more bipartisan than climate. But actually, the thing most Americans, both Republicans and Democrats, are worried about China is its environmental record. So under a Biden presidency, even if it would be quite tough on China, you could see an EU, US, Japan push on China to act better. And if I was China, I would get in front of that by doing something with the EU this year. And there's still the Leipzig summit, big EU-China summit in September is
Yes,
planned.
very true.
So you can see these pressures. Pressures can always flip both ways. And in many ways, it's the role of Europe with Japan and potentially India. If they decide to keep climate on the agenda, there's enough economic juice in that and financial juice around electric vehicles and some of the big parts of China's future economic plan that China would need to join in. And then the US is just a backmarker. Because the thing about the world now is it's no hegemon who can determine the fate of the world. Everybody's, even the US, is kind of a medium-sized power now. So again, we see it as quite a complex space, and we have to find a way of navigating through a kind of US-China tepid war to deliver on climate stability, because everybody needs it. And you can see it like smallpox or nuclear disarmament in the other Cold War. Some things, even when things get bad, people still cooperate on some things which are really seen as vital, and climate is one of those things.
Well, we got a interesting stuff here from the audience. So Alexander Mackay wonders if we need to redesign supply chains to have greater local production and less global transport of manufactured goods. Do you actually think that's the approach to go? I mean, traditionally, trade has been very much about comparative advantage and efficiency.
This is a really tough one because the biggest motor of climate action has been global supply chains and open global supply chains. And the kind of swing point was the 2013 solar case between Europe and China, where Europe decided to keep its market open and get cheap solar panels rather than propping up European solar manufacturers. And that sparked a solar boom globally. And there's a similar story in light bulbs and wind. So the cost reductions driven not by huge technological breakthroughs, but by global supply chain efficiencies have been the motor of climate action over the last 10 years, pretty much. So what happens, and there's pressure, and there's lots of different pressures to close down supply chains. It's really tough for lots of countries who are currently thinking of building coal power stations. They'll lose a lot of money if, Kenya, people don't buy flowers anymore. They're likely to move towards dirtier subsidized options. So we think it's really important to keep, we will change our supply chains, make them more resilient. It's really important that doesn't hurt smaller developing countries, and they need to be helped through that. But also in places like electric vehicles, if solar panels was the biggest ever Europe-China trade dispute, it will be chicken feed compared to electric vehicles. In the recovery package, I bet you every single country pours billions into their car industry to incentivize going to EVs and to building battery factories. How do you have fair trade when everybody has subsidized everything to death? So what we will actually need is a managed trade system in areas like EVs after this crisis, because there will be no WTO rules are totally insufficient to dealing with the kind of state support we're rightly seeing during this crisis. So I think anybody who thinks trade needs to stay open needs to be working really hard to make sure we move to a different regime. It cannot, WTO wasn't working anyway, but it definitely won't work after this, particularly on some of the big green tech.
Got a couple of questions here on tech. One's a bit loaded from Alice Bromwich. How do you think we can counter the preconception that environmentally sustainable businesses are not as profitable as mines, oil, gas, etc.? Any quick thoughts on that one?
Well, I think, as financial sentiment usually lasts around 2 to 3 years, as we know, in bubbles. At the moment, the sentiment is, environmental, socially, ESG stocks are doing well, and green investments holding up much better than oil and gas, which is tanking. So at the moment, that's not a hard case to make.
The numbers speak for themselves, don't they, really?
In the long-term economics. I don't believe in the V-shaped recovery, and if I look at the oil and gas markets, I fail to see how any of the private sector firms get another round of investment before we get to peak, until the impact of electrification really hits oil demand, and because Russia and Saudi and others will step into the breach. So in that way, there will only be green to invest in the Western stock market. And what the US does is going to be fascinating. What they do with all that shale investment and that pyramid. I imagine a lot of public subsidy. That's what always happened in the past. So no, the other crisis is in how is that market going to unravel, which is something which I think bumpily is the answer.
It's quite an incisive question from Christopher Gleedle. He's asking, with financial actors, why is the focus on more and more new technology and away from doing better with what we have through integration of hard and soft systems, which is sort of related to your point earlier about how trade has been one of the driving forces of improvement so far. Any thoughts on that? I mean, why is it always, Elon Musk and his Tesla?
I think it's because we're really, the marketplace is really good at getting new product out, which is quite like the old product, but with slightly different, looks financially and consumer-wise like the old product. And that's what renewables are like. They've essentially been, take out a coal power station, put in loads of renewables. You don't really have to change anything until you get to very high penetration rates. But certainly for Europe and beginning in China, we're running out of that as a solution. We have to get to the system change stuff. And that's why if the investment in the last crisis was dominated by big wind power, that was where the money went, and some efficiency, the investment this time around has to go into small scale resilience, retrofitting houses, lots of EV charging, which is precisely that kind of integrated, small scale, distributed infrastructure. And even though it's good cost benefit and it performs well on all the public good and the economic criteria, it's hard to get out the door at scale. So that's why I put this emphasis on delivery and the role of public banks. And how do we get the right stuff out of the door fast enough? It's not that it's massively new tech. It is this kind of different shaped tech and in different places than the old stuff. And that's much harder. That turns out to be much harder than paying a bit of a premium.
It's interesting because Alexander Mackay follows on in that thought. You made a remark earlier about things. He was sort of saying Eastern and Southern Europe need as much intervention. He's not sure they need as much intervention to reduce energy use and promote greening. Perhaps the West has a bigger problem with energy-hungry buildings, which need investment to green them. So potentially a big investment that could provide jobs for many lower-paid employees, which I think is the point you were just making there in a way.
Yeah. Well, the only one, most of the Western Europe has better performing buildings than the East, except the UK, that is at the bottom, just above Estonia in terms of poor building stock. Blame that on history and the Industrial Revolution or just bad policy. But there is actually, there is enough need to soak up a huge amount of money, both sides of it. The problem in Eastern Europe is a lack of supply chains and delivery instruments. And part of that is too much central government control. Another problem in the UK, most centralized country in the G20 for investment. If the UK wants to get this stuff out the door, it has to give fiscal sovereignty to the cities. Now, that's an interesting political discussion for this government because all the cities are controlled by Labour.
Well, we've got time for just 3 questions, but they'll still have to be brief answers. I'm not sure I should try and say this, but I will. Lasse Instafjord Alsfag, and he can correct me. Is greenwashing or reverse greenwashing of certain solutions considered a significant problem in recommending investment targets? And as examples, gives greenwashing wind farms versus the area destruction of a wind farm, or phasing out nuclear for clean coal in Germany. Are we going to see a lot of this kind of sleight of hand going forward?
Hopefully not. We do have much better kind of screens like the European taxonomy and the various rules at development banks now than we had the last crisis, which take all of these things into account. So hopefully there shouldn't be kind of false solutions peddled. And things like local environmental destruction is part of the criteria on a wind farm. It's not just the carbon. So they have to pass all those hurdles if they're going to get public money.
Second to last question here is really got to do, if you may recall, well, you will recall most definitely, back in the early 2000s, Bjorn Lundberg created his Copenhagen consensus to try and apply rational economics to a whole variety of decisions. And there were a lot of whys and wherefores on that. We're now starting to see a lot of that type of thinking come back in terms of what's the value of a human life in the COVID environment. Now, all this time, we've had the climate issues and the genuine and real effects of climate on people's lives, quality of life, and longevity, to the point that we had this interesting news item back in early March that China had probably saved more lives uh, by shutting down and therefore having less air pollution than it had saved in terms of COVID. So there's a lot of interesting stuff here. Do you think those types of arguments might come back to the fore? Cost benefit analysis, quality adjusted life years, social value of human life, or is that just not the way these things ever play out?
I think it'll be a lot more political and a lot more about the social contract. So, what's the value of social care? What's the value of excess capacity in hospitals? What's the value of building in, more costs to not be affected so much? I think the kind of the bankruptcy of the kind of Lombard CBA has just been shown by climate change is a system condition for the economy to thrive. You can't do marginal calculus on it. So we're looking to stay below a place where which the damage doesn't completely destroy our economy. And I think that's the kind of discussion. That's why the financial sector and the financial regulator is looking to support climate action, because it's a systemic problem, and therefore the CBA is just the wrong methodology to look at it. So I think I think it'll be much more political discussion and much more an issue of how do we preserve the system conditions in what side which our economies can operate, which needs new calculus. And I'm not sure what is the right calculus for that. That's actually a real test for us methodologically for how to do that going forward.
Yeah, which is interesting. I've been reading a lot on where COVID actually comes closer to climate change because of the pervasiveness of it. A lot of uh, traditional quality adjusted life years and things like that are dealing with small elements of the population that you can identify and look at, whereas this is a systemic one. Mind you, it always reminds me of that great Jay Leno quip, and there are very few climate change jokes that are funny, but he came up with something like scientists say that climate change is even worse than we thought, which is kind of surprising because I thought it was out to destroy the world. But anyway, there we go. Last question from Hugh Purser. In the context of today's discussion, and I think he's got a point here, you've ranged widely over great areas of economics and policy, and we've thrown a few hundred billion here and trillion there and gigatons back and forth. Um, but you talked about tailwinds, and one of your tailwinds was public interest in climate change. But is there really a role for the woman or man on the street to push this agenda, especially as so many people have realized what the situation is, the benefits of reduced fossil fuel activity, and the need for sustainability? As a time for awareness and public support passed?
No, because in the end, even in non-democratic countries, public support is what gives politicians a space to act. They tend to follow, not lead. And the good thing is, so far, the polling we've got shows that the concern on climate has held up, if not increased, during the COVID crisis in all the jurisdictions we've seen some data from. And we actually think, because the next stage is the real hard stuff like changing heating and transport and areas, it's actually really important that people see those everyday benefits and engage in it. Because without that, even in countries like the UK that have a good track record today, we won't do the next stage of deep decarbonisation, and we'll kind of turn off all the coal power stations and then kind of give up. So it's really important that one of the things COP26 will do next year, I think, is reignite that public debate, which has been swamped by COVID, understandably, but bring people back into the equation and show what they want and what they can do and what they expect from their politicians. And so that's the kind of diplomatic and public reboot we need towards the end of the year to play into COP26.
Hmm. Yeah, I think Louise Pryor makes a point here. How do you see changing working practices, for example, working from home affecting investment decisions? And I think in some ways, the more that we can push some of that agenda ourselves, which I think the average person can. Actually, I've got a choice: go to the office or work from home. Day to day, it will change and be different. But the more I bias it towards one over the other, the more I might be changing behavior in aggregate. An
Mm.
interesting point. Well, sadly, as ever with these darn things, we run out of time. Just as I'm getting more and more interested. I wish we could have more than just a virtual coffee or beer together, Nick. It's a real delight that you came on the show and gave us such a tour de force. Before I turn to thanks, I'm going to just briefly move through a couple of more slides here, just to remind folks that E3G is, in our opinion, one of the leading think tanks in the world on this entire subject. So please do go to the site. there are materials that were given to you on the chat area and will be posted when we post this webinar on the web page that you registered on. So there are more materials there and clearly on the e3g.org site. So please go there. We definitely want to thank all of our sponsors, but I'd also like to thank you for listening. And we do have other things coming up. We have a fascinating session tomorrow on something which sounds almost like the antithesis of today, own the world, but it's actually about immunizing your investments by diversifying. And then we've got a fascinating bit on looking ahead at the scenarios, picking up on our 2012 report, In Safe Hands, Look at the Future of Financial Services. Should be a vibrant discussion with Jill Ringland and Tricia Lustig. And then on Friday, a double whammy. Those of you interested in employee share ownership schemes should definitely listen to David Craddock as he goes through real case studies and what they achieved or didn't. And we have a fascinating area as well. The city of Xi'an in central China in Shaanxi province is going to be presenting their plans to further develop their financial center. And before you laugh, just remember that it's about 20% larger by population than London. So don't smirk. Meanwhile, if I may, and Nick, I would like to join the rest of the audience. Board lit up here, over 70 people, and I'd just like to say a virtual, if I sadly have to, thank you so much for coming on today and sharing all your thoughts and wisdom. It's been really, really helpful. Thank you.
Thanks for having me.